8 Recession-Proof Investments You Can't Afford to Miss. The global recession of 2008 was one of the worst financial disasters in recent memory, so it's easy to understand why many people are worried about another recession happening in the near future. According to a recent survey by the National Association of Business Economics, NABE, 72% of economists expect a US recession by the middle of next year. After all, no one wants to suffer through an economic downturn like that again. However, these days there are plenty of solid investments you can make, that will not only help keep your nest egg protected, but also grow over time to give you the finances you need down the road. This list features 8 investments you can't afford to miss. 1. Invest in businesses you know. You know the old saying, keep your friends close and your enemies closer? The same goes for business. When you're looking to invest in a company, it's always a good idea to go with businesses you're familiar with. Not only will you have a better understanding of how they operate, but you'll also be more attuned to news and events that could affect their bottom line. For example, if McDonald's announces a new breakfast menu or KFC introduces Colonel Sanders' 100% natural original recipe, then you can invest accordingly. Plus there are some advantages to investing locally, such as faster transportation or proximity to distribution centers, so make sure you're not neglecting local companies when considering who to buy shares from. 2. Bonds. When it comes to recession-proof investments, bonds are often at the top of the list. That's because they tend to hold their value better than other assets when the economy takes a turn for the worse. They also offer a steady income stream which is good for those with specific retirement needs. However, not all bonds are created equal, and some have more risk attached to them than others, so be sure you know what you're getting into before investing your money in this asset class. For example, if you invest in corporate bonds from companies that don't make much profit, then there may be a chance that the company will go bankrupt and won't pay back your investment. Likewise, government bond rates change depending on how risky they are as well. But like any investment strategy, if done right, then bonds can offer investors peace of mind through tough times as well as growth over time. 3. Certificates of Deposit, CDs. Just like savings accounts, so they're a safe investment even during tough economic times. And, because the interest rate is fixed, you'll know exactly how much money you'll earn on your investment. CD rates are often higher than savings account rates, making them a great way to grow your money. While CDs can be as short as 3 months or as long as 5 years, you should plan to keep your CD for at least 6 months. Otherwise, it will be difficult to make up the lost interest when you sell it early. Some banks offer different types of CDs, such as liquid CDs that allow you to withdraw your money without penalty during the first few days after opening the account, sometimes called bump-up CDs. If possible, go for this type of CD since it offers more flexibility. For example, if there's an emergency in your family or if interest rates go down, making your CD less valuable, you can always withdraw from this type of CD. 4. Commodities. If you're looking for an investment that will always be in demand, regardless of the state of the economy, commodities are a good bet. From oil and gas to gold and silver, commodities can provide stability and potential profits during times of economic turmoil. However, due to their inherent volatility, it's important to invest only what you can afford to lose and keep your position size small until you know more about the markets. Commodities do carry risks, just like any worthwhile investment. An investor must comprehend the markets for the product they seek to trade, such as the notion that oil prices can change depending on the Middle Eastern political situation. It also depends on what kind of investment you make. ETFs offer greater diversification and lower risks, but futures are more speculative and have higher risks due to margin requirements. Nevertheless, commodities can act as insurance against inflation, and gold in particular can act as insurance against a market slump. 5. Futures trading. Futures trading is one of the most popular forms of investment, and for good reason. This type of investment allows you to speculate on the future price of an asset, and can be a great way to make money in both good and bad economic times. As long as people want to invest, there will always be futures traders waiting for them. Furthermore, futures trading often only requires a small initial investment, which means that this type of investment is accessible to almost anyone. For example, the Chicago Mercantile Exchange offers trading with just a $25 deposit. There are many different types of futures contracts available for trade. These include commodities like coffee beans or wheat, and stocks like Nike or Microsoft. 6. Hedge funds. Hedge funds are one of the most popular investments during a recession. They are known for their ability to make money in both good and bad times. The average hedge fund invests in a wide variety of assets, like stocks, bonds, currencies, and commodities. The goal is to generate profits while also trying to reduce risk by diversifying the portfolio. But this doesn't mean you should invest blindly. It's important to do your research on which hedge funds are best for you. A good place to start is with a list of all the different types of hedge funds available. Then take some time to review what each fund does, how much they charge, and who they're investing with. Make inquiries with the ones you like, and get your questions answered. Then you can decide on the appropriate one for you to invest in. 7. Long-term stock ownership. Long-term stock ownership is one of the best investments you can make, regardless of whether we're in a recession or not. That's because, over time, the stock market has always gone up. What if your company goes bankrupt? A good example would be Enron. However, if you have held onto your stocks for at least 5 years before this happened and have owned them for at least 10 years total, then you will most likely be eligible for compensation from the Securities Investor Protection Corporation, SIPC. If an investment seems too risky for your liking, just keep investing in safe options like index funds. When it comes to stocks, consider diversifying your portfolio by investing in different sectors such as technology, healthcare, finance, etc. Once again, long-term stock ownership is one of the best investments you can make, so don't hesitate. 8. Mutual funds. A mutual fund is a professionally managed investment fund that pools money from many investors to purchase stocks, bonds, or other securities. While there are no guarantees when it comes to investing, mutual funds tend to be less risky than other options, making them a good choice for those looking to protect their money during a recession. If you're thinking about investing in a mutual fund, be sure to do your research and speak with a financial advisor to find the best option for you. Keep in mind, not all investments are recession-proof. If you have the time and expertise, investing in individual stocks may give you more control over what goes into your portfolio. Many people invest in exchange-traded funds, ETFs, because they trade like stocks but offer exposure to an entire market index. Index funds can also help minimize your risk because they track an index of multiple companies rather than just one company. They can help you avoid concentrated risk by holding few shares of each company on average. We appreciate you taking some of your valuable time to visit with us today. We are overjoyed that you did. Please hit the bell symbol to make sure you never miss an upload if you liked this one, and don't forget to subscribe if you did.